Geopolitics with David.
The end of the dollar doesn't look like a movie scene. There is no single day where the screens go black and the world suddenly switches currencies. The end of the dollar, if it happens, looks like something quieter and more dangerous. A slow loss of trust that changes the price of everything you touch. Your fuel, your food, your rent, your loan rate, without ever giving you one clean headline that says, "It's over." And that's why people keep missing it. They're waiting for a crash. But reserve currencies don't usually die in one punch. They bleed out in phases. And by the end of this video, you'll understand three things. What the end of the dollar actually means in real life, what replaces it in practice, not in theory, and what signals tell you the phase is changing before the public realizes it. I'm Professor David O'Brien. I study macro risk, how policy, debt, and global trade plumbing flow downhill into household costs. I'm not here to sell you panic or politics. This is educational content, not financial advice. Do your own research and consider professional guidance. Now, here's the map. First, the mechanism, why the dollar is not a currency, but an infrastructure. Second, the evidence, what the data says right now about the dollar's dominance and the quiet diversification around it. Third, the pattern. 3 historical precedents that show how reserve systems actually change. Fourth, where we are today, what stage this looks like, and what the next domino probably is. And finally, a watch list and a practical protocol. Principles, not predictions, so you can think clearly instead of emotionally. Let's start with the mechanism because if you understand this, you stop being vulnerable to clickbait. The dollar dominates for one simple reason. The world uses it because the world already uses it. That's not a joke, that's the core. Reserve currencies are network machines. The more people invoice trade in dollars, the more they hold dollars. The more they hold dollars, the more they buy dollar assets like US Treasuries. The more they buy Treasuries, the deeper and more liquid those markets become. And the deeper those markets become, the safer it feels to use the dollar again. It's a loop. It feeds itself. That's why end of the dollar is hard. You're not replacing a bill in your wallet. You're trying to replace the operating system of global trade. Here's the simplest analogy. Imagine global trade is a city, and money is the water system. You can't run a city on bottled water. You need pipes, pressure valves, and a place where the water is always available at scale. The dollar is the plumbing. Payment rails, commodity pricing, trade invoicing, insurance contracts, shipping finance, bank collateral, central bank swap lines, and the safe asset that everyone can park in when they don't trust anything else. Even people who claim they're moving away still keep one hand on the dollar pipe because their bills are still connected to it. So what does the end of the dollar actually mean? It rarely means the dollar becomes worthless. More often it means the dollar becomes less central, less automatic, less trusted, less used at the margin. That shift can be enough to raise borrowing costs, weaken crisis response, and make your everyday prices more unstable. And that is the real danger. Because the dollar's superpower isn't just purchasing power, it's that in a crisis, everyone runs into it at once, and that surge stabilizes the system. If that reflex weakens, the world gets more volatile even if the dollar remains number one. Now the evidence block, because this is where people get emotional and sloppy. If you look at the IMF's COFR data on the currency composition of official foreign exchange reserves, the dollar is still the largest reserve currency by far. The exact share moves over time, but the key point is it remains dominant, while diversification has been happening gradually at the margins. That combination, dominant but slowly eroding, is the signature of a system entering a fragile phase, not collapsing tomorrow. And here's the second piece of evidence that matters more than Twitter, the depth of the dollar's trading ecosystem. The Bank for International Settlements Triennial FX Survey shows the US dollar remains on one side of the vast majority of foreign exchange transactions. That means even when two countries trade with each other, they often pass through dollars as an intermediate step, like changing trains in the biggest station. When the dollar is the intermediate asset, it stays sticky, it stays embedded. Replacing that is not just a political decision, it's an engineering project. Third evidence, the world's appetite for US government debt. The reserve currency is inseparable from the reserve asset. You don't just need a unit of account, you need a deep pool of assets large institutions can hold in size liquidly every day with legal clarity. That's why US Treasuries matter, and that's why foreign holdings of Treasuries, tracked in the Treasury's TIC system, remain one of the most important thermometers for dollar dominance. When the marginal buyer hesitates, you see it here first. Now I want you to notice something. The same headlines that shout de-dollarization also quietly admit the world is still using dollars in huge volume, because it has to. Many debts, commodity contracts, shipping, and insurance systems are denominated in dollars, and even alternatives often use dollar-based rails. This is why the real question isn't, will the dollar die? The real question is, what happens if trust declines while dependency remains? Because that is the worst configuration. You're still trapped in the system, but the system becomes less stable. Now let's do the historical triptych, the pattern recognition that makes all of this feel less mysterious. First example, the British pound. Stage 1, dominance. London was the center of global finance. Sterling was the trade currency, and Britain's imperial footprint reinforced it. Stage 2, overextension. War financing, debt accumulation, a shifting industrial base. Stage 3, smart money exit. You don't wake up one day and sell sterling. You slowly increase the share of alternatives, you shorten duration, you diversify reserves. Stage 4, reset. After 2 world wars and a changing geopolitical order, the system migrated toward the dollar. Punchline, reserve status didn't vanish overnight. It lost inevitability first. Second example, the US dollar's own break with gold in the early 1970s. Stage 1, dominance under Bretton Woods, dollar linked to gold, others linked to the dollar, a managed stability. Stage 2, overextension, global trade expanded, US deficits grew, and the gold link became a constraint the system couldn't tolerate. Stage 3, smart money exit, foreign governments tested convertibility, confidence became a negotiation. Stage 4, reset. The link was severed and the world moved into a fiat dollar era. Punchline, the dollar survived, but the rules changed when the old constraint became politically impossible. Third example, the euro's creation, not a collapse story, but a system building story. Europe didn't replace the dollar. It created a parallel pool of currency and assets that could absorb some global demand. Over time, institutions, market depth, and credibility made the euro a meaningful second choice. Punchline, alternatives don't win by headlines. They win by infrastructure and boring reliability over decades. So where are we today? We're in a phase where the dollar is still dominant, but the world is actively reducing single-point dependency where it can. The signals match a fragility phase. Diversification at the margin, more bilateral trade arrangements, growing interest in non-dollar settlement mechanisms, and central banks building buffers that are not someone else's liability. And that last part matters, because one of the cleanest ways to diversify away from a reserve system is to hold something that can't be sanctioned, frozen, or defaulted on by another government. That is why central bank gold buying has been so heavily discussed in recent years. It's not because gold is magic, it's because gold is an asset with no issuer. Now, here comes the next domino, and it's the part most people aren't prepared to hear. The end of the dollar is not primarily about China replacing it. It's about the cost of funding America's role as the world's liquidity provider. The dollar system requires the US to supply the world with safe assets and liquidity, often via deficits and a gigantic treasury market. If global demand for treasuries becomes less automatic, the US can still fund itself, but usually at a higher price. And higher funding costs don't stay in Washington. They flow into mortgages, corporate borrowing, and consumer credit. This is how reserve currency fragility becomes your interest rate. So what comes next? Realistically, not one replacement. A stack, a bundle, a multi-asset, multi-rail world. Think of it like a battery pack replacing a single generator. No single unit does everything, but together they reduce dependency. The stack already exists in pieces. The dollar remains the primary engine, the euro remains the second, regional settlement grows, commodity-linked and gold-linked buffers expand, and digital rails, some public, some private, move value faster than legacy pipes. But, and this is critical, none of these pieces fully replaces the dollar's combination of market depth, legal predictability, and crisis liquidity. That's why the transition looks like fragmentation, not clean succession. Let's kill the 3 common objections before they spread. Objection 1. Reserve currency can't fail. Wrong framing. It doesn't need to fail, it just needs to become less trusted at the margin for the whole system to become more expensive and more volatile. Objection 2. They can print forever. They can create dollars? Yes. But printing doesn't create trust. Trust is a political and institutional asset, and it can be squandered. Objection 3. This time is different because America has tech and the military. Those are real advantages. They support dominance. But they don't eliminate the math of debt service, nor do they remove the incentives other countries have to reduce exposure to a system they don't control. The dollar can stay number 1 and still become less comfortable to live under. Now the clock and watch list, this is where you stop being surprised. I'm going to give you indicators that signal phase transitions without sounding insane. First, the IMF COFR trend. Not a single quarter, trend. A sharp multi-year acceleration downward in the dollar share would be meaningful, especially if it coincides with rising shares in multiple alternatives, not just one. Second, Treasury demand under stress. Watch auction tails, indirect bidder behavior, and sustained upward pressure on term premiums, signals that the market is demanding a higher price for duration risk. Third, FX market structure. If the dollar's share in FX turnover meaningfully declines over multiple survey cycles, that suggests a deeper behavioral shift, not just diplomacy. Fourth, commodity invoicing. Oil and LNG contracts experimenting outside dollar terms in a scalable way, not symbolic deals. Fifth, crisis plumbing. The usage patterns of dollar liquidity facilities, swap lines, and related mechanisms, because that tells you whether the world still runs to the dollar when afraid. Timeline, near, mid, long. Near term is months. You see noise, headlines, political flare-ups, and tactical hedges. Midterm is years. Infrastructure builds, clearing systems, alternative pools of safe assets, legal frameworks, deeper local bond markets. Long term is a decade plus. Cultural habit changes. That's the real timeline of reserve shifts. So if someone tells you the dollar ends this summer, they're selling you adrenaline. But if someone tells you nothing changes, they're ignoring the slow mechanics that eventually rewrite price behavior. Now, practical protocol, not what to buy. Principles. Step 1. Reduce single point failure in your own life. If one currency movement, one interest rate spike, or one bank policy shift can break your budget, you're too concentrated. Build slack. Step 2. Think in duration. Long duration promises, whether bonds, mortgages, or business models, are fragile in an era of monetary uncertainty. Step 3. Keep liquidity honest. Liquidity is what lets you survive volatility without selling at the worst time. Step 4. Diversify across real-world needs, energy, food, housing, mobility, because currency regimes show up first in those prices. Step 5. Avoid false certainty. The most dangerous mistake is going all in on one apocalypse narrative. That's not risk management. That's a bet on your own fear. Step 6. Invest in skills and optionality, because in monetary transitions, income resilience beats portfolio arguments. Step 7. Watch policy credibility like you watch inflation, because credibility is the invisible asset behind the reserve system. And here's the do not do this rule, because it's where people destroy themselves. Do not confuse volatility with collapse. Volatility is the transition's language. Collapse is the fantasy your nervous system craves, because it gives you one clean moment to point at. In reality, the pain comes from whiplash. Prices up, prices down, policy reversed, policy doubled, while you're trying to live a normal life. The goal is not to predict the final scene. The goal is to be structurally harder to break while the story is still being written. So what comes next? My view is this. The dollar doesn't die in a single event. It becomes one pillar in a more fragmented architecture. The world keeps using dollars because the pipes are there, but it keeps building bypasses because the trust premium is no longer free. That means the future is not dollar versus yuan. It's a world where settlement, reserves, and savings are more diversified, where the dollar remains central but less unquestioned. And when something is less unquestioned, it gets more expensive. That's the hidden tax. Now I want to ask you one question, because it reveals how you see the world. Which signal are you watching most? Reserve share, treasury demand, commodity pricing, or crisis liquidity? Put it in the comments and tell me why. Let me land this hard and clean. The mechanism is simple. Reserve currency dominance is built on trust, liquidity, and habit, and it weakens when trust declines faster than dependency can be removed. The stage we appear to be in is not collapse, but fragility. Dominant dollar infrastructure with growing incentives to diversify at the margin. The key risk is not that your dollars become worthless overnight. The key risk is that the system becomes less stable and more expensive to live in, through borrowing costs, price volatility, and weaker crisis shock absorbers.